Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So any other questions?
Hey, John, would you mind commenting for some of the attendees that, are interested, but they are still concerned, maybe that they go on vacation for a week and they're still short this option, which obviously isn't appropriate for somebody that leaves, they're not watching this. Could you just talk about maybe a credit spread that would allow people to go on a cruise or do whatever they want in case the markets get away from them, having limited risk?
Yeah, sure. So let's look at EUU. All right. So we'll look at the euro. And I mentioned that that if we were doing this analysis today, that maybe we sell an option with a strike price that sell a put specifically with a strike price of 150. Okay, so it's just theoretically, and I'm going to use some made-up numbers here, but I think I'll be able to make the point so that it makes sense. So let's say we've got a strike price of 150, and it pays us, let's say $2. This is hypothetically, and maybe we've got expiration 2 months from now or a month from now or whatever. So we make $2, right? But if the market goes down, we're golden. But if the market goes way up and we're gone on a cruise or whatever it is, we could start accumulating some losses if it starts to go through that strike price here at 150 and it goes up a couple of dollars above that. We can start accumulating some pretty good losses. And sometimes the market really does move very fast. So we can do some things to cover our losses. So let me give you, for instance, up here at 152, what we could do is we could buy a call with a strike price up at 152. And let's say that call at 152, and let's say that one costs us, $1. So it cost us $1 to buy this one, and we made $2 on the other one. So our net on this particular trade is $1. So we get $1 credit in what we would call a credit vertical spread. So we would assume that these two calls have the same expiration date. So we got this net credit of $1, and that way, if the market were to really take off and go way up above 152, the most we can lose is the difference between those two strike prices minus our credit. So it does limit our potential gain. We kind of cut that potential gain that used to be $2. Now we cut it into $1. But at the same time, if the market goes way up above 152, so let's say the market just starts to cruise and goes goes way up here to 153. Well, the short put that we sold down here at 150, that's going to be that's going to have a bunch of losses on it. But the long put will have offset a lot of those losses. So the only remaining obligation we would have is basically the difference between the two strike prices minus our credit, so we would have the potential loss of $1. Now I've used even numbers here. You'd want to work through this on your own, but by constructing a vertical spread like this, what you can do is you're using two options. You're using that long option as a safety net. That 152 strike price that we paid for, that thing's going to appreciate in value if the market really goes cruising, and it'll offset. It'll fix the potential losses that we could experience on the short option, so that you couldn't get caught off guard coming back, and you've got a $500 or $1,000 per contract loss. You've limited your losses by buying that protection. So I got a question here about selling options can be utilized to hedge a spot FX trade. Yeah, definitely. So I mean, you kind of look at it the same way you might look at selling an option against a long position in another market, or so yeah, you could sell a call in the spot You could sell a call option if you were short in the FX. You'd want to make sure that you're position sizing correctly. So, if these options kind of represent, $10,000 notional value, then, one contract would be a partial hedge for, one mini contract in the Forex. But you could use it. Personally, Carlos, you're going to be able to accomplish the same thing from a risk perspective just with writing the option. You wouldn't necessarily have to have the underlying position in the FX. Where you might want to apply what you've just talked about, what the question you've asked, is by buying a Forex option. So if you were, for example, if you were long, 10,000, a mini lot of the euro, and you wanted to buy a put of EUU, then you'd have a pretty nice little hedge there if you thought the market was really going to go way up. That put's going to protect you from the downside because you're long. So it's going to offset the losses if your spot position falls. But it'll still allow you those big gains to the upside, minus the premium you paid for the put. So protective options in that scenario are probably going to be more effective for you than trying to combine some sort of a sold or short option position with a underlying FX position. That's going to be a little bit more difficult to manage and probably unnecessary. Is there an options calculator on the PFX site? No. Nope. But
we have one at the ISC though. Yeah. They can come to the FX options.
Yeah.
At fxoptions.com, we have a calculator there. So John has a lot of information, but if he doesn't have that, come and visit us at fxoptions.com. We do have one there.
Yeah. I do want to answer this question that Vladimir asked about would you recommend any good tools to model trade scenarios? I know that there's some decent tools out there. A lot of brokerage platforms have some interesting modeling tools, by the way, that you may want to do a little research there. But in my opinion, there is no replacement for just getting your feet wet a little bit with some paper trading. So it just gives you a better feel for the market because any analysis you do today, just, options, there's a lot of moving parts there. Changes in volatility, changes in price, et cetera. So the best thing I can recommend is that the best tool is going to be your brain and your experience by far. There are very few modeling tools I find that are very helpful in the long term.
Hey John, would you mind showing us the Commitment of Traders report on your site? Because I guess I was doing something else and listening to you, and then I tried to find it. So I go to...
Sure. Okay, so you'd go to the Forex tab on our site, learningmarkets.com.
Right.
And we have kind of this these row of flags pretty much everywhere you go on the Forex tab of the Learning Markets site. And if you select any of these tabs, so for example, if you want to know what this Commitment of Traders report, so if you want to know what the institutional investors are doing, let's say on the dollar-yen contract, which would be YUK with the ICE options.
Okay.
So if I want to know what's going on with YUK, I can pull the Commitment of Traders report kind of halfway through the page. And I can see, well, what are the big institutional guys doing? Well, they're net short overall, so they're more short than long, so they're bearish. But recently, this little red line has been climbing, so they're getting a little bit less net short. So overall, they're short, but they're a little less committed to those trades. So we'd be trading pretty cautiously. We want to be conservative.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.